Everybody, welcome to the morning market briefing. It's Wednesday, September 28th, 2022. Tom, anything you want to declare?
I'd like to declare that it's fall, y'all.
It is fall and big time. Walked outside this morning, felt great. The most comfortable I've been taking the recycling up to the street in a while. Felt awesome outside. So hopefully maybe that sticks around. Lots to chat about today, giving you a little bit of lay of the land right now. Market's pretty flat. Dow is down 3 basis points, S&P down a little more, NASDAQ down a little more, but nothing terribly alarming. We were down a little bit more earlier in the morning, so kind of hanging in there. Lots going on, kind of some big headlines and stories. Let's start off with just kind of this crazy situation in the UK. We talked a little bit about the pound just plummeting yesterday. We've talked a little bit about some of the tax cuts they have going through, but now the Bank of England says they're going to buy long maturity bonds. I think the most noteworthy part of this is, quote, on whatever scale necessary in order to restore order to the market. Tom, a lot of action going on from the taxation side, a lot of action going on from the banking side. What are they trying to accomplish? And I mean, it just seems chaotic.
And they're kind of coming at it from both ways. I mean, initially, Bank of England was the first real mover in terms of raising rates and, being austere in its efforts to bring down inflation. But then, the economy has not done so hot. And then we've basically had a situation where the government has decided that they're going to cut taxes significantly, which is going to dry up revenues. But it's also going to spur bond buying and bond issuance, and it's also going to probably increase demand, which is going to increase inflation. And so they're basically the Bank of England is having to scramble now because the government has essentially put more gasoline on the fire that they were trying to put out. And the only way to fix the situation is to start buying bonds, because what's happened is fear of inflation has pushed borrowing costs through the roof. The UK is a very pension heavy country. And so all of those instruments, the bonds and the government bonds, the UK gilts that are in these pension accounts that are supposed to be the safety aspect of these retired people who are on the government payouts, all of those have evaporated. I mean, we saw their 10-year gilt, eventually basically their version of the 10-year treasury shoot all the way up to 4.5% extremely quickly. And then that was when the tax cuts were announced. And then last night, they basically said, we're going to start unlimited QE. So they're going back into quantitative easing in a big way. So the 10-year gilt dropped back down to about 4%, based on the fact that there's going to be enhanced liquidity because the government's going to be stepping in and buying bonds. And I think this is kind of the final, this is the bad side of Brexit. Because essentially Brexit was awesome during COVID because they had autonomy. They could do what they want. They could push out anything they wanted to in terms of, stimulus or governmental action. And it affected the UK and the UK only. But at the end of the day, it's a very small country. There's probably 60, 70 million people there. And they are on their own, and they're an island nation. And they're subject to all of the externalities that are involved with that. And they operate like a country that's as big as the US or even Germany, but they are not.
They're not.
And I think it's starting to come back to bite them now, which is that they're on their own. And unfortunately, they don't seem to have the governmental or the fiscal leadership on either side that's able to really wrangle this thing in, and it's starting to fall apart very quickly.
Yeah, and it's not necessarily shocking. I mean, I feel like thematically for a while on this call and macro presentation and other things, we've talked about just the challenges facing Europe at large, and the UK certainly has not been an exception to that. They may be one of the first that we see really suffer through this right now. You've still got the energy concerns longer term. I mean, there's just a lot at play here, and I think you say a lack of leadership, and I don't necessarily disagree with that, but I also think they've got a relatively limited tool shed, and they're just grabbing at tools trying to see how they can patch this thing up.
Yeah.
And it's hard to say here's what they should be doing, but you essentially have the government working independently of the bank, and both kind of running different directions.
Yeah, I mean, you're between a rock and a hard place for sure, because it's like you're an island nation. You're not super diversified economically speaking. Finance is a heavy hitter over there. I mean, it's just kind of a mess, and how they rectify it, I guess, it definitely remains to be seen.
Yeah, I think it's interesting, and we were texting about it with some of the guys that are out of the office coming back. Sam, for instance, today. I think the big thing we need to be mindful of, maybe here in the U.S., is I don't think it's out of the question that we will get to a point in which we have the government operating at a completely different direction than what the Fed is doing.
We're kind of already there.
Yeah, and I've said this repeatedly. Like, I'm surprised we haven't had more damage on things like unemployment and that kind of stuff, given where we are and given where rates are going and likely to continue to go. But I also don't think it's out of the question that we get some kind of stimulus.
Yeah. I mean, that's basically what the student loan thing
Yeah.
is. I mean, it's gonna spur demand, and it's gonna make sticky inflation.
Yep.
I mean, it's not ideal. So you got to have everybody working in concert, or this thing is not going to work out.
Meanwhile, we've got here domestically, the 10-year treasury hitting 4% for the first time in quite a while, a very, very rapid increase to get here. Tom, what kind of impact does that spike have?
I mean, it's definitely causing hardship in the fixed income world. We're seeing spreads just widen like crazy. We're seeing some hardiness in munis to the extent that on the short end, we're no longer seeing what I would call relative value on the short end, which is that short end munis have kind of held their levels, whereas the treasuries have blown straight through them. So we're, at least on the muni side, having to move a little bit further out in order to find the relative value in terms of duration. On the flip side, we have been buying a fair amount of treasuries for filling in gaps. I mean, you can buy a treasury maturing in the next end of next year at almost 4.4%. That's AAA backed by the U.S. government. I mean, that's a very nice place to park money for the short term, while I wait for a lot of our bonds to roll down and sort of regain their foothold in terms of what their pricing is. I tend to think we're at all-time peak inflation panic right now. I mean, I just don't see a scenario where being this high up in rates, and we'll talk about mortgages next, that there's going to be increased demand going forward. I think everybody looks around right now and realizes that the walls are closing in, that inflation is very high, that borrowing costs are going up significantly, that their 401ks and their balance sheets are getting hammered each day. And I think that for the first time, it's really going to be a situation where, knock on wood, inflation really starts to be wrangled in, because things have started to really fall off. And the average person, I think, is more aware of it now than they were potentially in May, not just Fed watchers. I hope that's the case. I hope that we see a little bit more normalization. Even if we could just hold these levels for a sustained period and get used to the new normal of where bond prices are, would be ideal. Have some stuff roll off the board. But I mean, every single day, stepping up 10, 15 basis points on the 10-year. I mean, that was the fastest move in terms of how quickly rates spiked in the last 4 decades. In the last week was historically the fastest move we've ever seen on the 10-year. And so it's gotten very, very rough very quickly. But rates move in a sawtooth fashion. So, when you see huge spikes like this, oftentimes you'll see a retracement that's, maybe not equally as strong, but very quick as well. So I'm hoping that, we can take advantage of some of this looseness in the market and probably see a retracement going forward.
Yeah, and I mean, we've seen the impact obviously on the mortgages flying through that 6.5% mark, up 1% in the last 6 weeks, applications falling, refinance falling. It's having impacts on the market and in other areas beyond just that. And I think that's something to continue to watch. We're seeing also, economically, iPhone, which I think is a lot of times a good litmus test for consumer demand. iPhone demand is faltering a bit. Apple says they're going to pull back production by as many as 6 million units in 2023. The expectation was for production to essentially be flat. They're still seeing good demand for their higher end product, the iPhone 14 Pro compared to lower models, but the overall demand just not coming in maybe where some people expected it to be. Apple down about 3.5% pre-market. Not necessarily shocking news there, I wouldn't say.
Yeah. I mean, I think everybody gets it. And I think that plays into the narrative right now that everything is slowing as a result of the rate situation. I mean, I don't love it. Apple's down 3.3% at the moment, which is pretty strong move, I feel like, for not so surprising information. But again, we've talked about it a bunch. The number of players in this market has dropped off significantly. There are people who have decided they're just going to get out, and that reduces volume. We're in the blackout period for buybacks, which reduces volume. And so we've just got a lot of momentum pushing to the downside and not a lot of people stepping in to buy at the moment. And I think that, is sustained until we kind of get through the blackout period and companies start buying back stock. But I think it's going to be, I think there are a lot of people who are reaching that capitulation level. They're washing their hands and they're getting out and going to cash. So I think that we're kind of getting a little bit washed out here.
The Nord Stream pipeline continues to be in the news for different reasons. I mean, this is a pipeline that's not actively bringing fuel to Europe, just really for geopolitical reasons. But now we've got 3 different leaks that have sprung in the Baltic Sea. There's reports that these were explosions that were actually picked up, people claiming that it was sabotage by Russia. I mean, the implication here is that, even if we were to just get complete relief on the Russia-Ukraine stuff, that's going to set back the timetable for getting energy back to where it needs to be for Europe, because now there's damaged pipelines. Even if things were to calm from a geopolitical standpoint, which is not necessarily what I think anybody expects, at least in the hyper short term, it's a setback.
Yeah. And I mean, I think that's the theme right now is that things are just a mess. I mean, we've got
It's chaos.
the war in Ukraine, we've got this Nord Stream thing, we've got, the Taiwan-China situation, we've got North Korea saying they're going to shoot off missiles because Kamala Harris is going over there. I mean, take your pick. It's a rough market out there. And, obviously we're doing our best to navigate it, but it's going to be bumpy, at least in the short term. And I think we just need to continue to focus on, clean companies. They may not be going up every day, but, are they going to exist in a year? Are they going to be better in 5 years? I mean, that's really how we have to focus at this point, because the markets at large are faltering.
Yeah, I think thematically it's kind of that emphasis on that mid to long term view. What are the companies we're buying now that we're going to look back and say, man, that was a great buy, with maybe a little bit of flavoring from kind of just thematic plays. Like, hey, here's an opportunity. There's a mislocation in pricing here. Let's take advantage and let's keep allocations tight, stay the course. I mean, I would remind everybody, we're really not changing allocations. As ugly as this market has been and as challenging as it may continue to be, we're certainly not at levels that would kind of break the model, so to speak, in terms of why we have allocations where they are. It's painful. It hurts. It probably sounds like we're a broken record saying we're going to keep doing what we're doing. But we're still very much in the realm of, hey, this is why we have diversified exposure, not only within each asset class, but across each asset class. And I think in periods like this volatility, it's where being active within accounts can help. It's where not only owning an index can be helpful long term. So it's kind of where we are. We'll wrap it up there. Thoughts and prayers to everybody down in Florida. Storm looks pretty brutal. So hopefully we'll hope and pray for the best there. Be safe, and we'll talk to you guys tomorrow.